Good afternoon and thanks so much for tuning into India Market Close right here on NDTV Profit with me, Niraj Shah and Harsh Seta. And well, to say the least, it's not looking a very pretty picture. In fact, if I can just get the outings up on the wall and just show you what's moving and what's not. And yes, I mean, this is a really painful fall today. We're now sub 22,150. And therefore over 4,000 points from all-time highs, except for India VIX, everything in the red. So that's the other statistic. And if you pull up the Nifty 50 heat map, I mean, the fact that we are running a point called markets weak, I think that's an understatement. Markets are not just weak, markets have really plummeted today. Everything has given way. And if you look at the Nifty IT in particular, with the 4.3% gash, is really sulking in trade. And there are some gainers, by the way. And imagine what would have happened if there was no HDFC Bank, which is up about 1.3% in the green. That would have been even more terrible. But on the flip side, IndusInd 6.5% gone. Look at the IT gashes in Tech Mahindra, Wipro, Infosys, TCS, 4% down a piece for each of them. I don't remember the last time I really saw this. So it's very painful, fairly concerning. And to mention that, as I give it to Harsh, it's not necessarily the worst performing index, because small caps yet again are doing even worse than the large caps, Harsh.
Well, yes, they are. So there's a deep gash both on the Nifty mid cap and small cap. The breadth of the market looking difficult. Of course, the Nifty breadth, we just saw that. Nifty 50, 3% shaved off the Nifty mid cap, or it's 3% more actually shaved off the Nifty mid cap. The Nifty small cap also roughly 3% plus lower. So pressure on both of those with regard to broader markets. Let's also look at the advanced decline. There you go. 2,070 declines to just about 160 advances, and that's where the concern lies and has been all through this calendar year. We've seen the advanced decline remain extremely weak, the breadth remain extremely weak, and that is not showing any sign of improvement, Niraj. And that is also an indication that you could continue to see weakness, because the breadth just looking extraordinarily weak in that sense. And that's one of the many indicators we look at. And even when we are zooming out, Niraj, in calendar year to date, you're looking at a similar kind of a breadth where it's been very difficult.
Yeah, it is looking very difficult. And which is why today I think we are doing a slight deviation from that, from the normal market parlance that we do, because we're getting in some heavy duty voices to try and understand what to do in a scenario like this, because this is, to a lot of people, this would be unnerving. I mean, we've been seeing losses every single day, but you would want this to taper down, the losses to taper down. Unfortunately, today at the end of the week, with the first day of Donald Trump saying that all tariffs are here, the markets have lost
out, now down 20% from the highs. All of those stats not looking pretty, but you're looking at, nonetheless, the US macro also not looking very good. So you're looking at jobless claims which came in higher than expected. Now, whether to take that positively or negatively is again a question, because ideally, if jobless claims are higher than expectations, then ideally rates should come off, which is positive. But likely the market reading this as a negative on the growth front. So US growth concerns clearly there. You also have everything with regard to tariffs, which is playing out. The other piece is FII selling $13 billion now in calendar year 2025 for India. You have a weak domestic macro. You'll have the Q3 GDP data coming in, likely to be at 6.2%. But if it were to disappoint, you could well see a reaction on that tomorrow as well. So not looking pretty on that count either. Got cut in earnings estimates around 1% or so in terms of EPS estimates 1 year forward being cut. 1222 now being the FY26 EPS. And 18.5 times is where the Nifty currently trades at, roughly at that EPS number. And broader market valuations were punchy, don't look particularly cheap already. You're seeing Jefferies in their marquee note, Greed and Fear, suggesting that the correction is even now warranted, and it has to correct towards the Nifty 50 valuation, broader markets, for it to make sense. So maybe some bit of more correction is what they are penciling in. But let's get in some expert opinion on that note. We spoke to some leading market voices like Herald van der Linde of HSBC, as well as Tahir Badshah of Invesco Mutual Fund, listening to some of their views on what's happening.
Money is moving in the direction of the United States, but that is changing as well. So if we see that money is moving out of the US and bond yields come off, then money would go back into emerging markets. That could be a first positive for markets such as India. I mean, it would be positive for other markets as well. If I talk to foreign investors, the key concerns that come up are twofold. One is, what if there's something really bad with Indian earnings? Maybe it's worse than we think it is. That is just normal, that comes up. If earnings are being downgraded, people just don't know where the bottom is. But the comparison we, for example, make is with Indonesia. Indonesia invested a lot, like India has done over the last couple of years, infrastructure, roads and railroads and ports and these sort of things. And that has led to increased competition domestically and a decline in margin in certain sectors. So is that something that will play out in India as well? That's uncertain for now. But I think it's fair to say that most of the earnings downgrades we've seen. The other concern that foreign investors have is, what are the locals are doing? Because if they don't really want to buy these markets anymore, there could be that there's further downside here. So the foreigners are looking at the locals are looking at the foreigners. We still are not clear where the earnings are ending up. As you say, rightly say, some money has flown back into the US over the last couple of months or so. But I think that might be changing, actually.
All right, let's get in somebody who doesn't have nerves of steel but nerves of titanium. By his own admission, Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers. And we need that, Manish, right now, because a lot of experienced voices as well are finally saying that, okay, this is now becoming a bit difficult to comprehend the pain. And the reason why it's important to get you today, Manish, is I remember that at about 23,500, when you had said 22,000 is a level which the markets could go to, a voice or two may have scoffed. We are now almost there. How do you see the landscape now from here on?
So Niraj, I reiterate again the fact that on 4th of June 2024, Nifty was at 22,000. It was very fairly valued. And 1 year has elapsed, more than 1 year has elapsed, or closer to 1 year has elapsed. Between that, you have some earnings growth. And in the euphoria of the third term of the incumbent government, we took the markets to 26,000. I think that got corrected and we are back to almost 22,000. I, by and large, genuinely believe that bulk of the froth is out of the markets, whether you consider the mid and small caps, whether you consider the large caps, whether you consider Nifty 500. Broadly, we are done. That's not to say that tomorrow onwards the markets are going to have a V-shaped recovery. It's going to be a U-shaped recovery. And the things that are troubling the markets right now, apart from the valuation part, which was there, that has got corrected. Valuations are no longer a problem. Now the not known factor is basically the tariff issue. And if we have done some work on this, and we believe that this tariff thing again is blown out of proportion when it comes to reciprocal tariffs. Of course, we'll see the final print whenever that comes, as far as India is concerned. But I think the differential duty is just about 5%. Of course, there are segments where the duty could be, like your agriculture will have a differential duty of 20%, or in automobiles will have a differential duty of 20%, and so on and so forth. They could be outliers, but on a weighted basis, India's basket, the differential duty is just about 5%. Whether that warrants such a scare and such a drubbing in the marketplace, I have my doubts. So all fingers crossed, but it now seems to suggest that we are actually traversing on the extremes. The world doesn't come to an end at any time. Every time it looks like that the world is going to come to an end. India is going to come to an end, but it doesn't happen that way. And, slowly and steadily, the markets will try to absorb all the negatives, and then we move forward. But broadly, all the negatives, according to me, are there in the prints.
Okay, so that's the big fundamental view, and let's get in a big technical view as well, and then combine both of these. Gautam Shah, founder of Goldilocks Premium Research, with us as well. Gautam, great having you. Thanks for joining in. I would love to know, Gautam, how are you thinking about this from a charts perspective? Because Manish Sonthalia is saying that the bulk of the pain may now finally be out. Some part of it in select pockets might be overdone as well. Are you sensing that circa 22,000 on the Nifty, or whatever levels we may be on the small caps, that a bulk of the pain is out? Could we be close to bottoming out?
Good afternoon, Niraj. In bull markets, it's always overdone on the way up, and in downtrends, it's always overdone on the way down. That's how markets are. And I think we've just been in a classical downtrend for the last 5 months, making lower tops and lower bottoms. But I think what's really surprised a lot of market participants is that for the first time, India has gone completely off track, in the sense of what global markets have done in these last 5 months. In the context of the rise that we saw in the last couple of years, we've retraced about 40% of the 18-month-long bull market that we saw. That's March 23 all the way to October 24. So keeping that in mind, the studies are oversold, but then the market has not shown any intent to rebound or recover from any level. I think a couple of weeks back, we were watching the 22,800 number. We stayed around there for about 7-10 days. And then once that number broke, what you've seen in the last 10 days is that the large caps and the top 100 have now come under pressure. They were relatively resilient in the last 3.5 months. So for the market to capitulate, you want the large caps to correct, which is what is happening. Now, in terms of numbers, I would say 21,800 is really an extremely important number where I feel the market can try to stabilize. A lot of the negatives I do believe is in the price. And as the market tries to discount the April earnings, I do believe that over the next couple of weeks, we should find some sort of a bottom and stabilize. So mid caps and small caps definitely offer great value at these prices. But I would disagree with the large caps because I think they've just come under pressure only now. And there is some more room for the large caps to go on the downside. So do not bottom fish there.
Okay, interesting views coming through. Don't bottom fish and at the large cap end. But Manish, Harsh also joining in, quickly wanting your view. So I'll take a cue from what Gautam was actually saying, Manish. He's suggesting that markets on both sides swing to extremes. You believe that 22,000 is largely fair value. Was fair value 4th of June, likely remains so now, in around. Do you believe that there is therefore a chance, given SIPs, given the number of new investors coming into Indian equity markets, that you could see a swing on the other side in terms of, is there further downside from here as a result of some of these factors?
Yeah, I think, the Nifty 50 is really not portraying the correct picture of what is happening in the marketplace. Even if you look at the Nifty 50 next, they are now crumbling big time. So, probably the broader markets are trading at closer to 17, 18,000 on the Nifty equivalent. That's the sort of pain that you're seeing in the broader markets. Whether that's justified, I would strongly believe no. And it all depends on how the earnings shape up. And I think, by and large, in the backdrop of the reciprocal tariffs and all of this, India, by and large, is a domestic-centric economy. Our share of global trade is not that big. Not to undermine the trade balance with the United States. That is the talking point of all the weakness all around the globe. But on the upside, that 26,000 was clearly a euphoria moment, and that has got corrected. Probably the market, is not reflecting the true pain on a market-wide basis. Nifty 50 is hiding a lot of things, and markets broadly would offer more value in the mid and small cap space as opposed to the large cap. I agree to that fact, and the last bit of capitulation always happens in the large cap space. And now that you are seeing a big capitulation on Nifty 50, again seem to suggest that we are somewhere close to the bottom.
Okay, so now I would love to know, Manish, and then we will try and take that question to Gautam as well about, where do people fish? Let's assume Manish, that people didn't have money, right? Or everybody's invested, but people can swap. Loss harvesting is a great methodology as well, right, per se. And you get into some stocks that you always wanted but couldn't buy, and now they might be at the same prices. So I would love to know, Manish, and I'll read the MK strategy note, that's the sell side, but they're saying that 22,000 is good. You are saying this is good. Where is it that you find comfort as pockets that you would keep an eye out for, if not buy currently?
So basically, consumption is the next big theme in Indian markets over the next many years on the back of the leeway that has been given in the budget, plus the 8th pay commission, which is going to get announced in the next year. That creates a good buffer for consumption stocks, and discretionary consumption would really do well. Financials, they hardly are impacted due to whatever is happening on account of reciprocal tariffs. So banks, NBFCs, insurance, capital market, these are the areas where bulk of the value resides on every downtake. And obviously, due to the readjustment of reciprocal tariffs or whatever you may call it, I do find good value in the technology and the pharma space as well. Of course, the final word of that will be taken when you actually see the announcements of the tariffs or the embargo on manpower in terms of H-1B visa and so on and so forth. But all these sectors do offer great value, according to me. Where you can really
Manish, I'm sorry, I'll have to cut in. Gautam, stay on as well because PM Modi is speaking. I have to cut across.
ये केवल भारत में यूरोपियन कमीशन की पहली यात्रा नहीं, बल्कि यह किसी भी एक देश में यूरोपियन कमीशन का पहला इतना व्यापक एंगेजमेंट है। और साथ ही कमीशन के नए कार्यकाल की सबसे पहली यात्राओं में से एक है। इस ऐतिहासिक अवसर पर मैं यूरोपियन कमीशन प्रेसिडेंट और कॉलेज ऑफ कमिश्नर्स का भारत में हार्दिक स्वागत करता हूं। फ्रेंड्स, भारत और ईयू की 2 दशकों की स्ट्रेटेजिक पार्टनरशिप नेचुरल है, ऑर्गेनिक है। इसके मूल में ट्रस्ट है, लोकतांत्रिक मूल्यों में साझा विश्वास है, शेयर्ड प्रोग्रेस और प्रॉस्पेरिटी के लिए साझा कमिटमेंट है। इसी स्पिरिट में कल और आज अलग अलग सेक्टर की लगभग 20 मंत्री स्तर की बैठकें हुई है। विभिन्न क्षेत्रीय और वैश्विक मुद्दों पर सिंसियर और मीनिंगफुल चर्चा हुई है। हमारी पार्टनरशिप को
That's Well, some sound bites on the India-EU FTA. Well, and we have our guests. Gentlemen, it's time to thank you for being patient with us today. Manish, I'll come to you first. You were finishing your point. Harsh just remembered that every single time that you are here, PM Modi tends to speak as well. So the last time the same thing had happened. But sorry, please finish your point and then we'll ask the same question to Gautam.
Yeah, so I think these were some of the areas where I find relatively more comfort. I mean, see, everything has fallen and so everything looks very appealing. But I think what has been time tested in India is basically your 3 PEG number. So any sector, any industry, any company, broadly, if you are very sure about the earnings growth, and if the market P is, let's say, market earnings growth is, let's say, 10% or 12%, and the P multiples on Nifty 50 is around 20, 22, so two times. I mean, if you are able to find value across segments, mid cap, small cap, large cap, which is in that ballpark valuation range of 2 PEG, then broadly you are okay. I don't see too much of a pain, provided you get your earnings right. There is value across the board, but I think the investment side of things, the so-called long-dated order book position, still can be, let go, and you could actually buy into a consumption and a financials and financialization and insurance and ITs and farmers of the world. You will be broadly relatively well placed. The cyclicality element in these sectors would be relatively on the positive side, as opposed to the investment related things where the cyclicality will now be on the negative.
Gautam, Niraj and me were just chatting that you have a knack for identifying turnarounds. At what point, or what are the sectors, is consumption one of them, where you're seeing a possible turnaround at this point?
Two things here. Firstly, if you talk about Nifty levels, obviously it's very difficult to pinpoint a level from where we could bottom out, but we can definitely use the technical tools to put out some numbers. So I would want to believe that 21,800 or 21,200, which was the low around which the election results were announced. So I think from any of these two numbers, I would want to believe that the market becomes a buy. And any which way, from a risk reward perspective and from a margin of safety perspective, the market is already a buy. The only thing is you'll have to keep a 12 to 18 month time frame. If you try to make money at the markets over the next 2 to 3 months, it might still be challenging. Having said that, I think the next big opportunity is really financial services. I think the takeaways from the budget has been financial services friendly, with more money in the hands of consumers. The takeaway from the RBI has been excellent in the recent past. In terms of valuations, financial services and banks are extremely well valued at this point of time. And the ratio charts are great because financial services is really the last man standing in the overall scheme of things with all that has happened in the last 5 months. So I do believe that banks, NBFCs, insurance companies, are a space that will do exceedingly well. And as the market stabilizes, they offer great value and great margin of safety. I would follow that up with another sector which we have liked is metals. And I think with how they are placed right now, I mean, look at the JSW Steel, it's 3-4% away from lifetime high. So some of the top metal stocks have actually stood out really well. So these two would be my favorite pockets. I'm actually quite bearish on IT and pharma. I think pharma is going to see a lot more downside. We've covered a few sell calls on IT in the last 1 week. And I think there is a down cycle that's going to play out on IT as well. So I'm just sticking to financial services and metals for now in terms of opportunity.
I'm tempted to ask this to you because I would have anyways asked you, right? IT 4% lower today. Now, you may have covered it. We're talking for the first time in a number of days. How much more downside do you see for IT from where Nifty IT is currently?
I think everybody in the market today is just forgetting the context of the rise. The IT index moved up 20,000 points. 26,000 became a 46,000 in a matter of about 18 months. So I think all the positives were in the price, and given the commentary that has come from the US and the feelers that has come from the US and the slowdown that we seem to be going through, it's pretty clear that many of these expensive IT stocks cannot stay the way they have been for many, many months. I think IT was a sector that was safe till last week. The breakdown has happened in just 5 days back, and now you are seeing some terrible setups in the entire IT pack. I would want to believe that there is another 7 to 8% downside for the IT index. And I think all top stocks will correct, including the mid-cap IT. So please do not get in there. Do not bottom fish there. I think financial services is your best bet.
Financial services being the best bet. Manish, quickly on to you. I mean, we did speak about the Nifty IT index and IT stocks being down 4%. I wonder if you have a view there. As well as I wanted to also try and touch upon auto, because that one is also under pressure today. The numbers, at least right at the offset, the preview numbers, they don't look too bright for the month of February. We're betting on consumption, but auto not really looking bright. What's your sense on both of these?
So, talking about numbers as far as IT is concerned, if you were to look out into the future because of rupee depreciation, because we are coming off a low cycle, as far as the IT space is concerned, you had a lot of order book positions over the last 2 years, not too much of execution. All of that will manifest itself in terms of revenue numbers, EBITDA and profits. So obviously, if you were to extrapolate the numbers, what we have today into 27, bulk of the IT name, decent ones, would be trading at 25 to 27 times FY27 number. That's not prohibitively expensive. And if the IT index was to fall another 5%, you will be in the ballpark of where Nifty valuations are, or maybe slightly expensive than Nifty valuations. But given the nature of that business, they have always traded at expensive valuation to the Nifty 50. So I do find a lot of value there. And given the propensity that India's rupee has further downside over the next 1.5 years, that will act as a cushion. And obviously, these are very high quality businesses where now artificial intelligence, you are getting many more deals, both at the GCC level as well as the third party IT vendors. So that's my take on the IT space. As far as auto space is concerned, look, this space is basically disadvantaged from a reciprocal tariff point of view. I mean, the differential tariffs on automobiles per se is basically around 20-23%. That is to say that if India was to export automobiles out of India to the US, the differential duty is that they are not charging, they are charging some 2-3%, and we are charging on whatever we import from their country in terms of automobiles at closer to around 28% or thereabout. So that's a negative for the automobiles per se. This sort of a problem is not there for the auto comms per se. So auto and auto comms, the differential tariffs is not that big, but automobiles, yes, the differential tariff is very big. And from an export point of view, automobiles will be a disadvantaged space. But as far as domestic consumption is concerned, I think, look, this whole cut in, the income tax is going to be felt after a while. That is to say, in the next 3 quarters, you're going to see the positive effects of consumption play out. It doesn't happen very quickly, it doesn't happen automatically and very immediately. But over a period of time, again, the auto space, I think will likely find, given that currently the SIAM, etc., are also talking about very muted numbers for the PV space, you are seeing this sort of a headwind in the automobile space, the passenger vehicle space. But I think that doesn't stand good for the two-wheeler space, particularly the premium segment of the two-wheeler space. Those are the segments which are likely to do better. But on an overall basis, I think within the next 2-3 quarters, you're likely to see a pullback or a buying even in the automobile space.
Buying in the automobile space, even though today not looking pretty at all. Let's pull up a TVS Motor, let's pull up an M&M, let's pull up a Motherson, Ashok Leyland, all of them down anything between 4 and 6%. M&M another 5.5% lower. But anyway, thank you so much, Manish, Gautam, for joining us this afternoon, giving us all of that perspective. Always a pleasure speaking with and taking your views. And while we are at it, also joined by Richard J.